Wall Street, it had better be a September to remember, that is, if investment bankers and traders looking ahead to those year-end bonuses want to avoid what's shaping up to be the worst quarter since the peak of the financial crisis. Sandler O'Neill analyst Jeffery Harte says revenue will have to be, quote, off the charts to rescue the third quarter. Bloomberg Markets magazine previously named Jeff one of its stock-picking champs. He is with us now on the phone from Chicago for more on Wall Street's prospects. Jeff, do you think the buy side, mutual fund managers, institutions, appreciate just how bad the first couple months of this quarter really were?
I think they might be coming around to it, but I suspect in general people didn't realize how bad it was. I'd have, multiple conversations with investors saying, but there's a lot of good things, like high-yield debt origination has been strong. High-yield bond spreads have come in. It should be a good credit environment. But really what we're seeing is investment banking without trading. The activity levels just really haven't been there. It's not unusual for kind of the summer, but I think coming off of it was a pretty bad second quarter. The overall market was expecting a bit of a rebound in activity levels, and when it comes to the trading side of the business, we didn't get it. We haven't gotten it yet.
Okay, well, you do point out that high-yield bond underwriting has been doing well. Some other primary markets, IPOs at certain points, for example, other debt origination has been ticking up. At what point will that flow through to the secondary market trading, the thing that provides Wall Street with the bulk of its revenue and earnings?
Yeah, that's the weird thing, really, is usually primary activity kind of fosters secondary activity, and you put the two together, and that's where the strong earnings come from. We're really not seeing it on the secondary side yet. What we're seeing is investors buying into new issues, but not really doing much else with their books. I mean, really, what it ultimately is going to come down to now that we're back, I think things will certainly get better activity level-wise now that kind of the summer's over and people are back to work. But the question will become, does a consensus form on which way the economy is going? Kind of what's the macro direction? And people start feeling confident to place directional bets again. I think as it's been, we're getting a lot of mixed signals, and nobody really feels they have an edge as to what direction things are going. For the record, though, I'm in the camp of things are going to prove out better than people think. So I'm actually quite a bit above consensus for the fourth quarter, but the third quarter quite a bit below because the summer's been awfully slow.
Why is that? Why do you feel comfortable making what is effectively a macro call heading out towards the end of the year?
Well, ultimately, when investing, specifically in the investment banks, you need to make a macro call at the end of the day because the economy is such a big driver of kind of corporate decisions. But I think there's a lot of things in the economy right now to like that the street is not focused on at all. It seems fairly myopically focused on the negatives. Corporate profits are still very strong. There's a lot of cash on corporate balance sheets. Historically, that's been a good indicator. Private equity firms are active again. Historically, that's been a good indicator. And we're still clipping it along at estimated GDP growth of north of 2%. It's not like the double dip is kind of staring us in the face. So, yeah, there's a lot of headwinds, but I think there's a lot of good things that the market is not paying enough attention to.